Home insurance premiums are rising across the United States, and for many working professionals, this shift is quietly increasing overall housing costs in midlife. For homeowners in their late 30s, 40s, and 50s, housing costs are not limited to mortgage payments anymore. The monthly structure now includes property taxes, maintenance, HOA fees in some areas, and increasingly higher insurance premiums. While mortgage rates often receive the most attention, insurance costs have become one of the fastest moving components inside the housing category. This change is not dramatic in appearance. It typically arrives as a renewal letter, a short notice, a revised premium, sometimes an updated escrow adjustment. But over time, it reshapes the stability many professionals expect from owning a home. Across multiple states, including Florida, Texas, California, and parts of the Midwest, insurers have adjusted pricing models due to weather volatility, construction material costs, reinsurance pricing, and litigation exposure. Even in lower risk regions, premiums have trended upward due to national risk pooling. For a mid career professional household, this increase rarely appears isolated. It layers on top of existing financial commitments. By midlife, housing payments are often structured around a mortgage locked in during lower rate years, property taxes reassessed upward, routine maintenance becoming more frequent, school district related tax adjustments, and now rising insurance premiums. The housing payments may still feel predictable on paper, but the escrow portion begins to move. When insurance increases, lenders adjust escrow requirements. That adjustment typically affects the monthly payment, even if the mortgage rate itself has not changed. For homeowners accustomed to fixed rate stability, this can create subtle payment drift. This is where housing costs become more dynamic than many anticipated. For working professionals in stable careers, healthcare, technology, management, education, engineering, income growth in the 40s often slows compared to early career years. Promotions become less frequent. Salary growth normalizes. Bonus variability increases. At the same time, fixed housing expenses rarely contract. Insurance is part of this pattern. Unlike mortgage principal, which gradually declines, insurance premiums reset annually. They are sensitive to external risk environments that individual homeowners cannot directly control. In some states, carriers have reduced exposure or exited markets entirely. That has reduced competition. Fewer carriers typically means less pricing flexibility. For homeowners who purchased between 2015 and 2021, the early years of ownership may have felt stable. Low rates, predictable escrow, manageable increases. The environment now looks different. Replacement cost calculations have risen due to labor shortages and material inflation. Roofing, siding, electrical systems all cost more to replace than they did 5 years ago. Insurers price based on rebuild risk, not market resale value. This distinction matters. Even if home prices stabilize in certain regions, insurance premiums can continue rising because reconstruction costs remain elevated. For midlife households, this intersects with healthcare cost layering. Employer health plans often become more expensive in the 40s and 50s. Deductibles rise. Out of pocket maximums expand. Family coverage becomes more costly. At the same time, homeowners are managing college savings contributions, retirement account funding, property maintenance cycles, and housing insurance increases. Each component individually may feel manageable, but collectively, they tighten monthly cash flow margins. Housing costs are rarely evaluated in isolation. Insurance increases can also influence refinancing decisions. Some homeowners consider refinancing to offset escrow growth. However, in a higher rate environment, Refinancing may not reduce total payments. The insurance increase remains embedded within the housing structure. In areas prone to storms, wildfires, or flooding, deductibles have also shifted. Percentage based deductibles are more common in certain states. That changes risk exposure for homeowners during a claim event. This dynamic can create a dual layer effect. Higher annual premiums, higher potential out of pocket exposure. For many working professionals, housing was originally viewed as a stabilizing anchor in their financial life. Mortgage payment predictability offered psychological clarity. Over time, insurance variability has introduced a less predictable element inside that anchor. It does not create crisis, but it changes expectations. The housing category now behaves more like an adjustable system rather than a fixed one. In midlife, financial planning tends to emphasize retirement accounts, career progression, and debt reduction. Insurance adjustments inside housing are often secondary considerations, yet their cumulative impact can be meaningful over a decade. If premiums increase consistently year after year, the total cost of ownership shifts upward even without moving homes. This trend is visible in escrow statements. Many homeowners first notice the change when their lender sends an annual escrow analysis. The latter outlines a shortage. The monthly payment adjusts slightly upward to compensate. The number may appear manageable, but repeated annually, the effect compounds. Housing affordability conversations often focus on home prices and mortgage rates. Insurance rarely receives equivalent attention. Yet, in certain regions, insurance growth has outpaced property tax growth. And unlike property taxes, which are locally governed and somewhat transparent, insurance pricing models are national and influenced by global reinsurance markets. That distance between homeowner and pricing mechanism makes the increase feel less visible, yet more structural. Another dimension is regional migration patterns. As populations shift toward coastal and Sunbelt states, risk exposure accumulates geographically. Insurance pricing reflects concentration risk. Even homeowners in relatively lower risk zip codes within those states may experience pricing adjustments due to broader regional exposure. For mid-career professionals who purchased homes in growth markets, this becomes part of the long-term cost structure of staying in place. Housing stability used to be framed around mortgage payoff timelines. Increasingly, it includes insurance volatility modeling. In addition, insurers are scrutinizing property condition more closely. Older roofs, aging HVAC systems, or outdated electrical panels may trigger premium adjustments or non-renewal notices. That creates a maintenance insurance feedback loop. Deferred maintenance can increase premium risk, but completing upgrades also requires capital. This interplay becomes more noticeable in the 15 to 20 year ownership window, often midlife. At that stage, homeowners may be balancing college tuition timelines, peak earnings years, retirement acceleration goals, and higher healthcare deductibles. Housing insurance growth layers into that complexity. Importantly, this is not a short-term fluctuation. Reinsurance markets, where insurers transfer part of their risk, have repriced globally over the past several years. Climate volatility modeling has become more conservative. Catastrophic event frequency has influenced capital requirements. Those structural shifts filter down to individual homeowners. For professionals evaluating their long-term financial stability, understanding housing costs now requires including insurance as a variable, not a fixed line item. This does not invalidate homeownership, but it changes the assumptions many made in their 30s. The housing payment you modeled at purchase is not necessarily the housing payment profile you will carry into your 50s. Escrow adjustments, premium renewals, deductible revisions. They are incremental, administrative, quiet, yet they contribute to the broader pattern of fixed expense expansion in midlife. For many American professionals, the central financial tension of the 40s and 50s is not income decline, it is expense layering. Housing insurance is one of those layers. It sits inside the housing cluster but interacts with broader financial pressures. Understanding this shift allows homeowners to view housing costs with greater clarity, not as static commitments, but as evolving structures shaped by national risk environments. And that shift in perspective is becoming increasingly relevant for long term financial stability in the United States.